Most people think financial analysis is complicated, yet it's one of the most powerful tools within your business. Moreover, if you know your numbers and you can take decisions based on those numbers, you can more set up your business for success. My name is Robert Endress, and over the past 14 years, I have built 11 profitable businesses and have generated over $500 million for my clients. So in this video, I'm going to give you a glimpse, very personal glimpse into the P&L of one of my businesses. This is a 6-month trailing P&L 3 years ago. However, this is the actual P&L that we used. I've changed obviously the client names and I played around a little bit with the words. However, this is the basic structure that we use, and this is how we make decisions based on everything else that we need to do in the business. So in the top left, we always have whatever this P&L refers to. So either it's the full year or a quarter or multiple quarters and so on. So you'll see that on the top left, and then you'll have a breakdown month by month. You can have P&Ls weekly, as literally depends on how often you make money and spend money. We have it monthly because months are the most appropriate for us. Large companies can have quarterly P&Ls, yearly P&Ls, and so on. And we also do quarterly and yearly versions of the P&Ls because you have to, in many countries, you have to provide the updated P&L for the quarter or the year if you want to take dividends for yourself or for your partners or anything else you want to do. Or sometimes banks require this. You have to have updated P&Ls so that you can give that to the bank and they can give you credit based on how successful the business is. So looking at this, you will see 20 clients lined up. Again, we removed the names. We just said the client number and then the type of service that we render for them. Then you can see in July, August, all of these months, you can see the actual income generated. And some of these might be off, like it's not an actual number because we trade in euro, we trade in pounds, and we trade in various other foreign currencies. And also whenever you make money, you do not actually get the final amount in your account. So what this shows you is the actual money that landed in your accounts. For example, if you use Stripe takes, if I believe, around 3% or 2-point-something% of the amount, right? So if it's $10,000, you'll only have 9,000, whatever. So whatever the end number is, that's what you put here in the P&L. You will notice a few things here. Number one, we have these 20 clients here. So that might be intentional or that might not be intentional. What I can tell you that in this specific year, in 2022, when we had this P&L, that was going away. This has become now part of our history. We don't have 20 clients anymore. Maybe we have 8 or 10 a year. And that's intentional because as you will notice in the P&L, we have quite a few clients. I'm zooming in here so that you can see that give us maybe $360, or we have here one that's $1,800 a month. And let's see if we have others. We have here one $1,400. Another one is at, $1,000 or whatever. So we had a lot of clients because a lot of people wanted to work with us. However, what I can tell you is that added a lot of management headache, a lot of admin, because you needed contracts for these people, you needed customer success for these people, you needed all of these outside services that have nothing to do with the service itself. But if you wanted to have high quality service and you didn't want to compromise even for low clients, then you had to, let's say, assume that you will make those expenses regardless of how much they pay you. And so we didn't want to keep doing that because our profit margins were significantly lessened for these clients. And we said, you know what, let's just politely say no to these clients. Let's find other partners that we can send them to. They can do great work and for less than we would charge. So we started doing that. And if you would look at the P&L for 2024, again, we have half or maybe less than half of the clients, but we make the same amount of money or maybe a little bit more, because we just focused on higher deals. So I'm going to zoom in here. Below clients, you'll see 3 more items. You'll see a line of credit, resale partner revenue, and then you'll also see other revenue. So lines of credit show up as income on your P&L, and you repaying the credit will show up as an expense below, right? The monthly installments that you pay on the credit lines that you've taken. So credit is a very good form of investment within your business, whether you want to invest in offices, which are assets, right, that you can buy and then the business is worth more because it actually owns physical offices, or you need cars, or you need laptops, or maybe more marketing, more whatever it is that you want to invest. If someone wants to buy your company and they look at that line of credit and that you have a line of credit, what they expect to see is one of 2 items. Either you took that line of credit for yourself as a personal benefit and you're buying something for yourself as the owner with the use of the company, which you can do and is normal practice everywhere in the world. Let's say someone has a $10 million company, they want to buy themselves a house, right? And then they can take a $3 million loan on that company. It's their company, they can choose to do that if they want to. So you can explain that easily in the event of a sale. Or the second thing that you can do is, if you got the credit as an investment into the company, your P&L needs to show the growth of the company, or the growth at least of the value of the company as a result of you taking that credit from back. Because the credit, let's say, has anywhere between 5 to 10% interest. If you make more than that as a result of taking that credit, then that buyer looks at that and says, oh, these guys know what they're doing. Let's say you take 100 grand and you pay 5% a year on that. So you pay 5K per year on that. But if you take that 100 grand and in the very first year of you taking that, you transform that into 200 grand, you had a 100% return on investment. And any investor or any buyer of a company would love that. Because now they know, let's say they need to pay you $1 million for the business, or 2 million, or however much you're selling for, but then they know, they have factual proof. For every $100,000 that they put in, they're going to make 200 grand extra, or whatever that number ends up being. Then after that, you can see reseller partner revenue. So I'm going to actually show you here. This is one of our partners, and you can have as many partners as you want. Again, this is a digital agency. It sells software development services and marketing services. So in this case, we are partnered with Atlassian, Zendesk, HubSpot, and a few others. And so this is revenue that we make by reselling systems within other businesses, right? So if someone wants, for example, Jira or Zendesk, because Zendesk is called Zendesk in itself, Atlassian has multiple different products that we can sell. So whatever you sell, let's say 500 seats of Jira for a company right in Canada. That might be, 50 grand for the year, or whatever that would cost. So you sell that at whatever your margin is on top. And then in the bottom, if you scroll down here, you'll see we have a line item that says resale partner costs, right? So if I go here, you'll see that in the month where we made $52,000, we need to pay our partners $25,000, because obviously we need to pay for the service itself, for the product. The same here, if I go to the December month of this year, you can see we made $146,000 in that one line item, and we had to pay our partner $112,000. And so our profit there, just from that, you can see is around, what is that, 34,000 almost. And then the final thing we have here is other revenue. You will notice that I shrunk a lot of these into one line item, and I will explain why in a second. But other revenue is anything else that you make revenue from. For example, you can have courses online, books that you sell, you can do events, you can do seminars, you can do trainings. You can do a lot of other items that are not your core business. However, they still generate revenue. So in this case, you'll see that we made around $10,000 here in July from something that we sold there, and another $17,000 in December. And so again, these are when and if in our case, because we focus on the main parts of the business. This will give you total monthly income, right? After you add up everything that you have in terms of revenue, let's see if this can give me a total anywhere, let's say 750. So $750,000 we made in 6 months. So if you extrapolate that for the year, that's actually quite accurate. We made a little over 1.5 million that year. So that's that business. And then if you look at cost of goods sold, this is a very important thing to remember. So when you provide services or anything, products, it doesn't matter. When you provide some sort of value to the end client, whomever they are, you have certain costs that are specifically dedicated to rendering that service or delivering that product. If you would, for example, bake cakes, cost of goods sold would be the raw material, the oats, sugar, cinnamon, and so on. So all of those raw materials and the people there that are actually putting everything together and baking that cake. That would be in cost of goods sold. And every P&L should have a difference between cost of goods sold and the other expenses that the business has. Why? Because in the case of a sale, many times, and this is the best way to sell a business, you would sell it as a strategic acquisition of someone else. So let's say someone else already owns agencies, and they already have a very senior HR department, they already have lawyers, they already have an accounting team, right? So any costs that are below costs of goods sold, they can basically almost cut off or reduce by 80% because they already have those, and they will use economies of scale. So maybe if you own the business and you have all of these additional costs, your EBITDA maybe is 200 grand. But if they take on the business, they might make 300. as a result of that because it's a strategic acquisition. So cost of goods sold, you'll notice we only have 3 items here: contractors and reseller partner costs. So reseller partner cost, again, is basically the raw material that we use because we have to pay Zendesk, we have to pay Atlassian, we have to pay, HubSpot or all of these partners for whatever their, let's say, products are actually worth, and whatever we sell on top of that in terms of onboarding or in terms of additional sales, that goes to our bottom line, right, in terms of profit. Contractors are basically the people, the developers, the marketing people, everyone else that is involved within rendering the service. And then you have taxes here. Normally taxes are not part of cost of goods sold. EBITDA stands for earnings before interest, taxes, and amortization. And so you would not have taxes here normally. You would have this below. However, I've been trading in companies for, let's say, around 7 to 8 years, maybe the first time I sold a company. And so we've already had 3 successful exits, a little under 20 million in total value, deal value of those 3. Whenever I sell a business or whenever I buy a business from someone or invest into it and so on, I always include taxes in costs because there is a way to reduce taxes, like for example moving to the Emirates or moving to other places where there is no corporate tax or the corporate tax is way less than you would have here. However, in the vast majority of cases you cannot avoid taxes, right? And again, maybe avoid isn't the correct term, to basically strategically find a way to pay less taxes so that you make more profit at the end of the month. And so you would assume that someone that you buy a business from already tried to pay the least amount of taxes, so this is the lowest amount that you will pay. So in our case, we made $144,000 in July of 2022, or that one business did, and then our taxes were $10,000, a little over $10,000. In the next month, you'll notice we made $93,000 and our taxes were $15,000, right? And so on and so forth. So you'll notice all of these taxes here, and I consider that as part of the expense of the business. You should not try to avoid them. Whenever you make money, first thought should be how much of this will go to taxes. So looking at that, we can say that it is a necessary part of the business. Again, if you move the entity to another country where you do not pay taxes, then this can be reduced. However, I consider it as part of cost of goods sold. It's just logically, if I buy your business, if you ever want to sell and you want me to be your buyer, I will consider taxes as a mandatory expense because I'll probably not move. If your business is in France, I'll probably keep it in France. So whatever taxes you pay there, I'll probably have to keep paying as well. So that's that. And then this basically gives you your gross profit, right? So you take monthly income, right? You take away cost of goods sold, and that is your gross profit. You'll say we made 50 grand in July, 26 grand in August, 33 grand in September, and so on and so forth, right? Until the end of the year. So after that, you have operating expenses. So operating expenses are everything like, for example, your Slack subscription. Let's say if you have phone numbers, right? Whatever you pay for that. Your Google subscription, right? Like the G Suite. Your own, Jira or your own Alvanda account or whatever it is that you have, right? So anything that you actually pay for on a monthly basis goes on to operating expenses. And the basic argument here is that you would be able to render all of the above services without these operating expenses. So if you all of a sudden do not have an HR team, you can still do marketing. You can still develop for your clients. If you do not have an accountant, in theory, you can still, do all of the work for your clients. No legal team, you can still do all of the work, etc. Right? So anything that is not 100% tied to the rendering of the service goes down to operating expenses. And so normally here you will only see 2 because I didn't want to go too much in detail, but miscellaneous here can be, 10 items on your P&L, and it should be 10 items on your P&L. The only reason this is just 2, again, is so that we go faster through this, and then software is anything you pay for, right? So we have a significant G Suite bill because we have 30 employees at the time or something like that, and then you have various other things that we would be paying for. So that gives you the total monthly expenses. As you can see, they're very small in this business as compared to the cost of goods sold. And then that gives you EBITDA after all of that. So 45 grand, 23. So let me actually add these up. So 60, let's say 70, 100, 120, 120, 180. So $180,000 in EBITDA. If you extrapolate that for the year, that gives you around $360,000 in EBITDA, which means that in the case of a sale, agencies sell between 4 to 8x, whatever their EBITDA is. So this would sell between 1.3 and $2.6 million if I would have wanted to sell it at that year, right? So let's say I would have maybe sold it at 1.6, 1.7 million at the time, right? So that's how you calculate that. Now you'll notice a few other costs that I recommend you do it this way. If you're the owner of the business, you'll obviously have costs associated with that business that are yours. In the case of a sale of the company, the future owner of the business would not have those costs for themselves. So this is what I call owner expenses. Here you see leasing, which are basically the monthly costs of cars that we have in the company, because those cars are cars that we use. So if anyone comes into the company and buys the company, they would not need those cars, right? Because I use that car and we have another employee using that car. If again it's an employee and they want to keep that employee and the car stays in the company, then it would go here to operating expenses. So the leasing for that car would go up. But in my case, in the case of a sale of a company, what I would do is I would basically pay off that car and give it as a gift to the employee or something like that, right? Whatever the case may be. So now if we look at loans, if you have taken loans on the business and the business is repaying them back, if it's for the business itself, as in, let's say you're taking 100 grand to put into marketing, so you make 200, 300, half a million from that 100,000, then it stays as an operating expense. However, if you took those and you bought assets with them, whether again that's cars or real estate or whatever you bought with that credit, and you intend as the owner to keep that in the case of a sale, right? So if someone comes here and says, hey, I'm going to give you $2 million for this business, let's say I accept. If I take that, I'm going to make it very clear, okay, out of these $2 million, 10% I will put back into the company to pay off the loans, and I will keep whatever assets that company has. So that's here in loans, basically. So the new person owning the company will not have this operating expense because I will pay off the loan. So the reason why these numbers are high is because we had very profitable months, as you can see. And then based on those months, I was making advanced payments. You can see it's very different month to month. Again, it was based on the month. We're making advanced payments on the loans that we took prior. And then finally is miscellaneous other expenses. For example, these are very small because in our case it was just maybe gas for the car, right? Again, the new owner will not be responsible to paying gas in my car if that comes to be. So this is basically a P&L, and all of these you can take line by line by line and then see how you can make improvements. So in our case, if I look at this, just the sheer number of clients, for me, it doesn't give me anxiety, but I don't know how to say it. Like, it's worrisome when I look at number of clients and then the differences in revenue. So the first client, you can see we make $22,000. The next client, $2,000. Doesn't look good. The third client, we make $27,000. The fourth client, $6,000. Right? And so another client here is $300. I don't like seeing that, or I didn't like seeing that in my business, because that tells me there are large differences between the level of services, between logistics of remembering who has what service at what level of intensity and so on and so forth. And so that adds complexity to a business, and I did not want complexity. All of my businesses are lifestyle businesses. I spend very, very little actually involved in them, maybe an hour, 2 hours a week or whatever it is, and then I expect that business to run seamlessly without my intervention. The way you can do that is by having a very simple service offering, right? Even if you offer multiple services, but each one of them is very similar to the other. And so the number of times people can make mistakes or get confused is way reduced. This is one thing I would do in this business. If I would look at this and I would think about it as an acquisition, the first thing I would say, okay, how do I reduce this complexity? How do I take all of these numbers and condense them into less accounts with the same amount of profit or maybe more profit, right? Which ended up happening in the case of this business when we did that. Another thing you can look at is client lifetime value of the various services you have. So for example, you can see here software development and digital marketing. I can tell you right now that within our industry, at least, marketing tends to, in most cases, have higher lifetime value in terms of how much you can count on that client still being there than software development. Because software development many times is 6-month project or 1-year project, whereas marketing, we have some marketing clients that have been with us for 5 years, maybe, because we keep doing marketing for them, they keep making more money. There are exceptions in software development as well. We do have some clients that we have for maybe 7 years or something like that, but those are actually the clients we kept even until 2024 and 2025. And so looking at this, I would also look at, if I would be you in your business, think, okay, what makes me the most amount of money recurringly, right? So for example, if again, I have a bakery, how often do people buy actual cakes? Well, you can say, okay, maybe they buy it twice or 3 times a year, once for themselves, once for, their spouse, once for their child, whatever. However, how often would they buy, something like coffee? Or how often would they buy those items? If those items you don't have on your stock, but that people would buy them more often, would show up more often, right, before work, after, whatever, maybe that's something that you should be thinking for your business. In this case, again, take every P&L item, every income stream, and say, which one of these can make us the most amount of money for the longest amount of time, and focus your efforts on those. If you do not have anything like that, if everything you do is one-off, then think of items that you can add into your P&L, right, into your income stream that gives your business some form of consistency moving on. And that level of consistency will then be much more valuable both for you, to your mental sanity, because you know how much money you're going to be making next quarter and next year based on actual data that you have, and also for whomever buys the company, you can show reassurance. In terms of contractors, the thing you can do, or employees, contractors, whatever you have, the thing you can do there is to motivate people with bonuses instead of higher salaries. So this is something we do all the time. If we have an amazing month or an amazing year or something like that, we give out bonuses to the people on our team. They're very happy with their Christmas bonus. We have anniversary bonuses. So whenever you have 1 year, 2 years, 3 years, and they're all higher and higher every year. So if someone that's been with us for 5 years gets 5 times more than someone that has been with us for 1 year. And so those are some of the items. We talk about it in our book Unshackled, or in the course, we have. We can probably link to both of those in the description. But basically, there are many ways in which you can reduce the monthly costs of contractors, yet still have very engaged individuals, very high quality staff. You can, of course, outsource to different countries, or you can work with other, let's say, partners, people similar to you that can offer the same service for lower. Reseller partner cost here, you can negotiate. We add this, and we started doing reselling of other people's stuff because our clients started asking for it. So for example, if someone would come to our software development agency and say, we need infrastructure, we need to manage tasks, we need to manage goals, we need to manage whatever, we would not bill them, whatever, $5 million or whatever it would cost to build every single thing that, tools like Elvanda or Atlassian or Zendesk have. Those are already there, and you would maybe pay, 20 grand a year to have all of them. And so it's much, much cheaper to have a partner to resell that, and then the end client is happier because they paid less. You still make some margin, and either way they wouldn't have spent $5 million to build all of their tech. So whatever makes sense in terms of cost of goods sold, for you to reduce the complexity of your business, you should do that. In this case, the reduced complexity comes in terms of sales, because we don't need to convince anyone anymore, right, to invest $2 million into building custom technology to manage their business on. We just resell whatever is most appropriate. In most cases, it's Elvanda. Sometimes it's maybe Zendesk, or sometimes it's something else. And then in terms of taxes, again, you can look into how you can pay less taxes, but again, please, legally, do not evade taxes. You can avoid them legally through some means. Like, for example, in certain countries in Europe, if you spend the money that you make, you do not pay taxes on profit, for example, right? You avoid taxes on profit, if I remember correctly, are around 8%. So you can reduce your taxes by 8% by spending the money, using the money again to buy, real estate or whatever you want to buy. Let's say you have 100 grand at the end of the year. So the government would take $8,000 from that, or you can spend that 100 grand and buy something with it, whether again, that's computers, that's a trip, whatever. Let's say you spend 50 grand out of it. Now you only pay taxes on 50 grand, not 100 grand, right? So you can make your investments at the end of a calendar year, basically. And if you do that, then you won't have that expense next year, so you'll be even more profitable next year. However, you've reduced your taxes for the year that just passed. So these are just some things that you can do in terms of taxes, or you can, again, move to another country. There are countries or states, even within the US, we have companies in specific states because corporate tax is less in those states. In terms of operating expenses, these should be as low as possible. Do not pay, like we made the mistake at one point, for example, we had an accounting team that was $2,000 a month, $24,000 a year almost. And the sales process for them was very, very good. So they said, if you work with us, we will analyze your P&L for you. We will come up with insights on what you can do. You know, we will be your CFO, your strategic partner, you know, helping you basically make your money back from those amounts that you pay us, right? So let's say you pay them 25 grand, but they help you find an extra 100 grand a year in how you can optimize your business. The sale of that was amazing. I loved it. I said, yes, I want more strategy. I want to delegate this, you know, and if you can do that for me, that's amazing. However, we started working with them, and after 6 months, the level of insight that they would come up with is like, you're paying a lot for contractors. I'm like, okay, and? Oh, we just thought you should know. Well, no, you said you're going to come up with strategies based on these insights. Oh, well, yes, but we don't know your specific business. Okay, I'm summarizing those conversations, and they basically did not add value. So now we have accountants at, you know, maybe $100 a month or whatever they cost. So we reduce that cost by 19x. Right? And so that's why you can see our operating expenses are very, very small. And I suggest the same thing for everyone. Let's say you have a Google account. Are you going to use anything else in the future? Because if not, and you're paying monthly, might as well either with Google themselves or with a Google partner, try to pay yearly for that and get a 20% discount, right? So let's say right now you're paying $8 per user, you have 20 users, you know, it's $160 per month or around $2,000 a year, right? If you pay monthly. However, if you pay for the full year in advance, instead of $2,000, you might pay $1,200. So that's $800 that goes back into your pocket. So anything you can reduce, either software or anything else you have, look at that line item and see how can I increase my profit margin. Then you get to EBITDA. Obviously, this is the actual worth of your business. This is what, if you sell the business, this is what the new owner would get. This is how you should measure the success or failure of your business, you know, based on the EBITDA it actually generates. And then anything else like leasing, loans, owner expenses. My only remark there would be only use money of your business if it is your business that will not harm the business's health or the future of the business or things of that nature. In this specific example, all of these amounts have been investments into things that we wanted to own eventually. And so we've done that. And then now we're in a very good place. We've paid off quite a lot of these, as you can see. And then you can basically have a company that, if you look at EBITDA, you can look that this company made whatever $360,000 in EBITDA, but it also owns assets of $500,000 or $1 million or whatever that is. So the value of it increases, or again, in case of a sale, if you want to keep that, you can keep that for yourself. So that's basically it. If you guys have comments, you know, you can leave them in the comment section, or you can email us directly. We'll leave our email there. Also, as a bonus, we can have this template in one of the courses or in one of the things that we will be sharing down below. At the end of the day, we want to be there for you. We want to answer all of those questions. So let us know whatever answers you want, and then we will make sure to film videos on those subjects. I wish you an amazing year. Hopefully this was helpful, and I will see you soon.